Hello everyone, welcome to a market update. Today is Thursday, the 11th of April. Hope you're having a good week. And how time has been flying by. Top three things today are inflation, hotter than expected. We had a number that came out last night. I'm going to talk about that. Geopolitical risk, which there's a few things that are going on out there in the world which may very well impact oil prices, and I think that's something to take note of. And then volatility and what's been happening with volatility, and specifically the setup for volatility, what that has meant in the last couple of months, and what it does to markets in the short term, and how we take advantage of that and play that. But first, let's talk about inflation and the hotter than expected inflation figure that came out last night in the United States. The CPI print was 3.4%, I do believe, which was higher than expected because, and I'm just going to check that while I keep talking, but the pundits out there were expecting inflation to come down probably more to that 3 to 3.1% rate. Sorry, 3.8% consumer price index core CPI year over year, 3.8. And I think they were expecting 3.2 or 3.1, something like that. And so inflation is reaccelerated, and this is a serious problem. I don't know if it'll still be up on this screen, but let's just have a quick look and see. If you go to CNBC, there's an interesting article actually right now on the homepage of the CNBC website. It may still be there by the time you see this video, but it's talking about supercore inflation. I've never heard this term supercore. I'm not sure what is in supercore, but it probably takes more things into the measurement of that, whatever supercore is, like probably housing and a few other things that they tend to not have in core inflation data. And I did glance at this article, but I'll quickly look at it again. On an annualized basis, it's something like an 8% inflation rate in the U.S. So this is, and that's Jerome Powell, by the way. If you don't know who that is Jerome Powell, the head of the U.S. Fed. And this is now getting really serious. It's a serious problem. Inflation has stopped going down. I've been talking about inflation with you for quite some time, and we've seen, and I've given you commentary about what we've seen in Australia as well. Inflation seems to have sort of paused at slightly above 3%. Will it reaccelerate in Australia? I don't know. We'll have to see when the next number comes out in Australia whether we have seen an acceleration in inflation in Australia. Anyway, this is a problem, and I think I've shown you this slide before. This is the CPI projections going forward. So this would be the core CPI projections, and as you can see, Hedgeye has they've done the math on this, and CPI is going to stay elevated. It's going to stay in that mid 3% range. And it's mathematically baked into the cake for the rest of this year. So we are, just to remind you, we are in a quad 2 environment where growth and inflation are both going up. So as you can see, the quad map for the next couple of quarters here is for us to be hovering right around this quad 2 and even possibly a quad 3 scenario or outcome, but right on this line here where again, inflation and growth are both accelerating. Now, I've said it before, and I'll just reiterate this, that we have come out of a global industrial recession, and we're now in a more expansionary phase. And we're seeing that in the U.S. economy. We're seeing that in China. We're seeing that in Australia and other economies around the world. Europe as well is coming out of recession. Big economies like Germany, France as well. The UK. So things are improving, and that's what quad 2 is. It's inflation and growth both accelerating. Now, the interesting thing with all of this is, what is the Fed going to do? They were talking about, even in the last couple of weeks, they had some Fed heads out there talking about 3 interest rate cuts this year. And that's going to be a real problem for the Fed now with this inflation print. They would have to be sitting there in their ivory tower right now, wringing their hands going, what are we going to do about this inflation? Because, and I've talked about this before, so for anyone who's new to watching these videos, welcome. And please continue watching them because usually there's some interesting morsels in here like what I'm about to say, which is if the Fed starts to cut rates, all that's going to do is stoke the fire of inflation. It's not going to cause inflation to fall. If anything, a rate cut will cause inflation to rise, which puts them in a very weird spot, which is if they cut rates too soon and inflation reignites and say it goes back up to 4.5%, 5% or something like that, they just have to turn around and increase interest rates, which they don't want to have to do because it makes them look really dumb, and of course the other flip side to that is it will cause even more volatility in the markets, and it'll just consternate the consumer and a number of other things. So the Fed, I think, is very likely to just hold course here. And the caveat on that will be if inflation on the next print, which we'll get another read in another month, goes up again, in which case they might actually have to increase interest rates. So the bond market, up until probably yesterday, had 3 rate cuts sort of baked into the cake of interest rates for the remainder of this year. I dare say that's probably off the table now, and there are probably no rate cuts currently being priced into the bond market. And, in fact, bonds, long, short, and middle of the curve, in terms of duration bonds, have all been going up. So I'm just going to quickly have a quick glance. So the U.S. 30-year closed yesterday around 4.62 or 4.62%. And if I just go all the way back to when this notebook started, where were we? So this was back in November. The U.S. 30-year rate was at 4.81. So it's come down. But if I just go back to the middle of this, let's go back to January. Here we go, end of January. The U.S. 30-year was sitting at 4.31. So as we entered the new year, I think that largely the whole conversation around rates was that we were going to see rate cuts this year. And if you pay any attention to the financial media, then you would know that that's what they were talking about. And so now the bond market is actually signaling, probably not going to happen because this inflation issue is not going away. So I just thought I'd highlight that because it's going to continue to be a problem for the Fed. And again, probably unlikely for us to see any meaningful interest rate improvement this year. And I think that'll also play out in Australia because, remember, we import a lot of inflation depending upon what our currency does relative to the U.S. dollar. So if the Aussie dollar weakens against the U.S. dollar, we will pay more for all the things we import. And what's one of the big things that we import? You guessed it, energy. So petrol, fuel, diesel, distillates, oil, all of it. Now we typically only import refined products here. We don't really have much refining capacity left in Australia. I think there might be 1, maybe 2 refineries left in Australia, which, by the way, I think is a huge geopolitical risk for us, which actually is a great segue into point number 2, which is what's going on in the world right now that could also impact inflation. I think in one of the last couple of updates I've mentioned that what's going on right now in the Middle East could very well intensify. And what is going on in the Middle East? Well, again, for those of you who follow any of the geopolitical stuff going on, there seems to be increasing tensions between Iran and the U.S., Iran and Israel. Obviously, Israel and Palestine conflict is ramping up. And just largely, it seems like Israel at the moment is being viewed as the bad guy in the Middle East because of what's been going on, particularly with this war that they're prosecuting against Palestine. But there are other players in the region now kind of getting drawn into other side conflicts. And I'm overgeneralizing this, of course, because the Middle East is a big place and there's lots of different countries there and a lot of people who don't like each other over there. And I guess to boil it down to one thing is if any meaningful conflict breaks out in the Middle East, we're going to see the price of oil spike. If there's a terrorist attack, the Houthis, which I'm not sure exactly where they might be in Iraq or floating around Syria, somewhere in there, but there's a group of people called the Houthis, and they're attacking um, ships and stuff in the Red Sea, and they are disrupting whatever they're doing with their attacks on these ships. They are disrupting trade flows, and that's one of the reasons why we saw a spike in shipping costs, because they were active and doing attacks and things in that, I'm pretty sure it's the Red Sea, and disrupting things, right? So, and causing shippers to have to choose a different route to go instead of through the Red Sea and through the Suez Canal there. So anyway, I just thought I'd highlight that, because if you do watch the nightly news, and of course you'd probably hear about it immediately if it were to happen. But if we see any meaningful escalation of military activity, and especially if the U.S. gets involved over there in any meaningful way, and I don't know. I don't have any insight on this. I don't know if they will or won't. But this is one of these black swan situations where, something bad could happen. A bomb goes off, an embassy gets attacked, you name it. There's any number of things that could go on over there, and all of a sudden the oil price is going to be $150 US a barrel. And that, of course, will feed into the whole inflation issue, because with oil at $150 a barrel, we have a completely different inflation paradigm, because energy, and just to remind you all, energy feeds into everything. So we are an oil and a petrol economy, no doubt about it. No amount of green energy is going to be able to be produced anytime soon to take us off this energy standard. And so we are at the mercy of the things that happen geopolitically that affect the price of oil. And I mentioned a moment ago the geopolitical issue of us not having refineries in Australia, because we actually have oil here. We have oil fields, we have gas fields, etc. And we probably have gas refining capacity. And I'm talking about LNG, natural gas, and its other derivatives. But without the ability to refine oil in Australia, I don't know what our strategic oil reserve is, and I dare say we probably don't really have one. I don't know that we have developed or have a plan for a strategic oil reserve. And I talked about this years ago when oil went from $50 a barrel up to $150 or $180 a barrel. And I just am stunned that Australia hasn't taken our energy security a bit more seriously. And I don't know why they haven't. There may be reasons, but it is just something to be aware of in the back of your mind. Finally, I want to talk about volatility. And this is really interesting, because the volatility of the market right now is being driven by short-term events. So what do I mean by that? Well, this is a chart from Tier 1 Alpha, which is one of the Hedgeye partners that provides a lot of data around what goes on in the options markets and what that means. And you probably, well, hopefully you can read it, but right here, this is the event yesterday, the CPI event. And what this 22.29 is the forward-looking volatility that was being priced into the market around that event. Now, all this is showing you is what the market was expecting in terms of volatility around that event, and then other things get priced off of that. And as you can see, it drops off substantially, because lo and behold, there are no events coming up really in the next month that have the potential to cause the market to have a big rally or a big sell-off. And volatility works both ways, by the way. You could have a big, huge rally and an event. So, for example, if that inflation number had come in at 2.5%, well, we would have had an epic rally. And that would have driven a little bit of volatility, but it would have come off fairly quickly. But the point is that when market participants have, for example, this volatility of 22.29, this is on the VIX, by the way, they have to do and behave in certain ways behind the scenes and trade their books in certain ways. And I'm talking about big major players who have huge flows of funds that they have to move into the market, and particularly in volatility, there's a whole group of funds that are just volatility funds, and all they do is trade volatility. And so what that does is it causes flows to come into or out of the market. And this event has caused and has perpetuated a sell-off. Now, I don't expect you to necessarily understand all of this because I'm still learning about how these short-dated volatility metrics affect trading. But what I do know is that the setup of the market is a quad 2 environment. And when we get events like this, because event risk, it happens and then it's over. We've got the CPI number, event risk, done. We got the number, now on to the next play. And what this does is it creates an opportunity to buy or to sell. Could be cut both ways. But in this case, it created an opportunity to buy. Now, and which is what I have been doing over the last couple of days. I've been actually selling some things into this event, and then I did a little bit of purchasing of some inflation hedging ETFs in certain industries. And then we're just going to go back to probably sort of normal volatility setup and see volatility come back down. The last thing I want to say about volatility is the VIX closed yesterday at 15.80. That's the closing value of the VIX. That's still in the investable bucket. And I would expect over the next, and if you want to look up the ticker for the volatility index of the VIX, it's V for Victor, I for Indiana, X for X-ray, VIX. Look it up and watch that metric. As the week unfolds and as we get into next week, I would expect that the VIX will probably come down. And again, that will cause more flows, more money to flow to equities and back into the market. So suffice to say, there's a lot of stuff that goes on behind the scenes. And I think to lock off this whole point about volatility is knowing what the market is doing around pricing a particular event is something that I have to pay attention to, because again, it will create an opportunity to do something. And in most cases, it will be an opportunity probably to buy something or potentially to sell something. And I think I'll just leave it at that. Anything else I need to say at the moment? Probably not. I think, again, the main thing to take away from where we're headed for the rest of this year, and I do want to actually reiterate this, is we're going to sort of bounce between quad 2 and quad 3 environment. Inflation is going to continue, so that puts us in on this side of the quad map in 2 or 3. And I think it's really just going to be a case of, well, do we see growth continuing? And I think the answer to that is yes. There's a number of metrics that are suggesting that we're going to continue to see growth, but we may be in a situation where growth may come down a little bit and inflation will kick up, which will put us marginally in that quad 3 environment. But for the most part, this year's theme is going to be we're out of the growth, the global industrial recession, and we're now into a global expansionary period, and with inflation. So I will be positioning the portfolios accordingly, and in fact, at the moment, really, there isn't a lot that I will likely be changing, except to I'm hoping actually to be able to add some energy exposure. There's only a very little bit of energy exposure in portfolios at the moment, and I really want to get some exposure to oil and some oil companies in particular. Exxon Mobil would be the one I would probably be choosing. So you might see the ticker XOM enter in the portfolio. I could buy the XLE, which is the energy ETF, which would be fine because one of the largest holdings in there is Exxon, but unfortunately it's got a couple of other companies that I don't really want to own, like Shell and BP in there, as well as large allocation. So in this case, I'd probably choose to just allocate directly to ExxonMobil and maybe Chevron as well. I think they're the top 2 holdings in the XLE. And of course, actually it's worth mentioning that gold and silver have been on a tear. So I have been surprised that we haven't seen the gold miners and the junior gold miners perform better. Now, they've been performing and they've been going up. The ETF on that has been going up. But the price of gold is now at a new all-time high. And what I have been observing, and I've looked back on a chart of the GDX, is that the last time gold was around the 2,000 plus level, both the GDX and the GDXJ, so gold and junior gold miners ETFs, were higher than they are right now. So I'm really not sure what to make of that. On the equity side, I can only guess maybe that that sector is not currently getting a lot of flow, and that may change. But having said that, the we have exposure to those particular sectors, a little bit too much in GDX, which I'll probably trim once we see it a little bit higher. I think that's about it, really. In any case, it's just going to be really looking at growth over the next over the remainder of this year, I should say. And we're going to obviously keep an eye on inflation, continue to watch interest rates, and continue to see what the Fed has to say about all of this, which I'm sure we're going to be hearing more from the Fed in the next few days. So with that, I will leave it. And actually, I will mention one more thing. I am planning on another lunch event. So this is now sort of more of a broad call out. Many of you know that I run this Keystone Cash Flow investment. Many of you have been invested in that previously or are now. And most of the underlying asset in that is with a firm called Palace Capital. Because I have an AFSL, I'm considered a wholesale investor, and I don't know that I have any clients that are considered wholesale investors. So the way to access Palace is through my Keystone investment. And it's really a yield play. And I had a fantastic lunch not long ago for a group of clients that I'd invited who are existing clients in the Keystone stuff to go to the Palace offices in Double Bay and to join me for a lunch. I'm going to be scheduling another one, hopefully, in the third week of May, another lunch at their offices in Double Bay, and I'll be inviting folks to participate in that. It's only a small gathering, 7 to 10 clients. We do a boardroom lunch, meet the MD, Patrick Keenan, and do a little walking tour around the Double Bay area where they have currently 3 of their large development sites with their development partner Fortis. I'm also going to be producing a video shortly to give you some education on the credit market. So one of the things that this Keystone investment is all about is providing a higher yield, but only a yield. It's not a growth play because there's no capital gain on the money that you invest. It's purely getting an interest return or an interest rate. And this has the effect of being a nice offset against the equity portfolios that are going to have more volatility. Plus, a credit portfolio is secured in that there are underlying assets that are secured by the loans. So if you've ever heard of the term capital stack, it's kind of a nice fun-sounding term that we use in finance. You are at the very top of the capital stack, and that means that you are going to get paid first if anything were to go wrong, versus being an equity investor where the worst case scenario is the company stock goes to zero and you lose everything. So a very nice way to barbell sort of a portfolio to get cash flow coming in, and this is a cash flow play in my mind. Cash flow coming in combination with your growth and other longer term assets that need to be considered long-term assets and viewed accordingly. So that's all I'll say about that. Any interest in that, please let me know. Again, I'm going to be putting a video together for my client base, around what investing in credit means, etc. And just to provide some education for you. So that's it. Have a great rest of the week, and I will leave an update again, or do an update again next week. Talk soon. Bye-bye.